It's now 5 to 8%. And you're going to find it in the second paper of the exam. So the first paper in computer-based testing is going to be all of the ethics questions. So you get all of your ethics questions. Then you get what they call investment tools. And investment tools is quant, econ, FRA. Okay, so you're going to get those quant, econ, and FRA questions all mixed up. Then in the afternoon exam, you get your portfolio management. You get corporate finance portfolio management. And then the rest of the afternoon exam, or second paper, if you like, is on the investment tools. So equity, fixed income, derivatives, alts, etc. So portfolio management will be appearing in the afternoon or second paper of your computer-based testing. Okay, so we're not going to cover all of portfolio management today, but we are going to certainly cover a fair chunk of it. And what I want to really focus on are these areas here. So portfolio risk and return part 1 and part 2, because really what we're talking about here is MPT, or modern portfolio theory. So we're looking at the work of Harry Markowitz. Okay, so H. Markowitz. (1952), and essentially William Sharp, which was 1964. Okay, so we're really looking in this area at the development of modern portfolio theory, taking it all the way up to CAPM, the capital asset pricing model, which was 1964. Now, we go a little bit beyond this at level 1, but not a lot. The introduction of multi-factor models, we touch on it at level 1, and that's the work of Stephen Ross, and that's 1976. We touch on it at level 1, but we'll develop multi-factor models more in depth in the level 2 syllabus. Okay, so let's have a look at what we are facing. Come on. So we're going to start off with just a nice simple area, making sure we can calculate mean, variance, and covariance. All computations that come up here, all computations that, of course, also come up in your quants material. So mean return on asset A, very simple. Up the return, so 5% minus 2%, 12%, and divide by 3. I'm sure you're all pretty comfortable about doing that. Mean return on asset B here, 7% minus 4 plus 18. So 7 minus 4, 18, divide by 3, and you get 7%. So I'd expect you to be pretty comfortable about arithmetic mean. But of course, what we also need to be able to do is calculate variance and the covariance between these two assets as well. So let's start off with our covariance and have a look at asset A. So when we calculate, and you've got here variance, if we want to calculate standard deviation, all it is the square root of the variance. So notice what we're doing is we're taking each return, so 5%, there it is, and we are subtracting the mean return on asset A, and then we're squaring it. And of course, the reason we square in these computations is that if you didn't do that, when you add up, you'd always get a value of 0, because what, of course, standard deviation is measuring is dispersion around the mean. And by default, 50% of observations by size are above the mean and 50% are below the mean. So if you just compare observations to mean and then sum, you always get a 0. So that, of course, squaring sign is to prevent that from happening. What that, of course, is going to do is turn any minuses into pluses. So then we've got our next return, minus 2%. Okay, so there it goes. There's our minus 2%. Minus the mean return of 5%. So we end up with minus 2 minus 5 and square that. And then finally, our 12% minus 5 and square that. And then, of course, what we're going to do is sum those squared deviations from the mean. What we then do is divide by n minus 1. So n minus 1 is the number of observations minus 1. Why? Because we're trying to get the sample variance. Okay, now we talk about sample standard deviation and sample variance when we're in quants, but I find a lot of candidates don't really understand what we mean. In particular, when we look at sample variance, and this is sample variance, you can tell you've got a sample variance or a sample standard deviation because you've got n minus 1, number of observations minus 1. Now, what sample variance or sample standard deviation is and isn't is the following. Let's start off with what it isn't. It is not the standard deviation or the variance of the sample. Okay, now that seems a bit confusing given it's called sample variance or sample standard deviation. So then the question becomes, well, what actually is this? So what it is, when you're looking at a sample variance or a sample standard deviation, you're looking at an estimate of the population standard deviation computed using sample of data, okay, using a sample of data. Now, what we've got on the bottom, n minus 1, is known as Bessel's correction. What Bessel said is if you just took the standard deviation, which of course we could do by not subtracting the 1, so if you were to take the population standard deviation for the sample and say that is the same as the true population standard deviation, what you would find is that you had underestimated the true population standard deviation. And the reason for that is a sample is never going to contain the extreme outliers that exist in the population. So what Bessel said was to get a better estimate of what the true population standard deviation is from a single sample of data, we should actually divide it through not by n, but by n minus 1. And of course, that's slightly smaller than n. So what that's going to do is it's going to force the variance up. And that's trying to take into account that we haven't captured all of the outliers. Okay, so in this case, you get 49. Okay, now you can do it. We've done it with whole numbers here. So we calculated the mean as 5, and we're therefore looking at, you know, the return as 5 minus 2 minus 5, etc. If you want, you can do it with decimals. I have to say I prefer to do it with decimals. And if you did that with decimals, you would get 0.0049. Now, remember, the standard deviation of an asset is just the square root of the variance. So if we take our variance of 49 and we square root it, we get 7%. And of course, standard deviation, the key thing about standard deviation is it comes out in units of measurement that are the same as you are using for your data. So because we're looking at asset returns here as percentage returns, then our standard deviation comes out as a percentage. Okay, let me just get rid of that ink there. So then we move on to have a look at asset B. So if you remember on the previous slide, we were told that asset B, or we computed that asset B had an arithmetic mean of 7%. So when we calculate the variance of asset B, we take its first return, 7, minus the, again, mean for asset B, 7, and square it. The second return, minus 4, minus the mean of 7 and square. And then finally, the third return, 18, minus the mean of 7 and square, all over n minus 1. Okay, remember always sample variance here. People also get very concerned in the exam when to use sample standard deviations and when to use population. Well, the basic idea is if you have got historic data, i.e. a sample of historic data, then you're always going to use sample standard deviation and sample variance. If you've got probabilities in the question, so it tells you the asset's return and it tells you the probabilities of those returns occurring, and those returns add up to 1. Because you're looking at all possible future outcomes, then you would be looking at population standard deviation and variance. So typical rule, if you're using historic data, then it's going to be sample standard deviation and sample variance. If you're forecasting and you've got probabilities and they sum to 1, then use population standard deviation and population variance. So when we do this, we get 121, or again, if you're working in decimals rather than whole integers, then you get 0.0121. Square root that, and we end up with 11%. Okay, 11%. Lovely. Now, I want you to be able to do this on the BA2 plus calculator. So let's just bring up a BA2 plus calculator. I've got an emulator, so I'm going to bring my emulator up on the screen. Let me just shift it slightly out of the way so you can see it. Okay, so I would certainly recommend doing these computations not manually, but using the BA2+. To do that, we need to do second function and then go into data entry mode, which is the number 7. And you'll see X01 appear on your screen. Now, our issue with our calculator is it will store data, and simply turning it off and on again is not enough to get rid of the data. So what we need to do is once we're in the data mode, we need to press second function and then clear equals cancel, and that will strip out any data stored in our calculator. So I'm going to work this in decimals. Okay, so I'm going to take the asset A, and its first return was 5%. So I'm going to type in 0.05 on my calculator. Then I need to press the enter key. And if you don't press the enter key, it doesn't store your data. Then press down and you'll see Y01. What your calculator is now asking you to do is enter the return for the second asset. So this was asset B in our example, and it was 7%. So 0.07, and then again the enter key. Press down again, it changes to X02, so it's asking you now for the second return on the first asset, and that was -2%, so 0.02. You want to get minus, then you hit the plus minus button next to the decimal to get your minus up, and then press enter. Press down again, down arrow again, you get Y02. It's asking you for the return on the second return on asset B, and that was 4% or -4%. So 0.04, negative, and enter. Good. Right, okay, now we've got that data in. We can go to our next slide. And we're looking at the third return now. So once we press down, we get X03 on our screen, and that is 12%, so 0.12, enter, down arrow, and then finally the third return on the second asset, asset B, 18, and enter. Okay. Right, I've now got all my data in there. If I do feel I've made a mistake or something with my data entry, notice you can just use the up and down arrows on your BA2 Plus to review all of the data that you've entered so far. So you can check if you want in the exam to make sure it's correct. Okay, now what I need to go into is stats mode. So I'm going to go in second function, and then I'm going to go to number 8. Can you see above that? It says stats, and it says lin. Now, your calculator might not say lin. You can see there's a lot of different modes, natural logs there, exponentials, powers, 1 minus v. Now, actually, you'll only ever need in the exam 1 minus v and lin. If you're dealing with a single asset that has probabilities of outcomes that sum to 1, then you need to use 1 minus v. You're telling your calculator you only have one variable. That's what 1 minus v means, in which case it will interpret any y data you enter in the calculator as the probability of the x variable occurring, or the x return occurring. Now, in our situation, our y data wasn't a probability of the x variable occurring, it was a second asset. So I need to change my calculator to lin mode, because then the calculator will interpret the y data we've entered as a second variable. So second and enter, and you just press second and enter until you see lin. And lin, of course, stands for linear regression. Now, when I press down, you can see it says n, and n is the number of paired observations in this case. So I've got 3 paired observations, 3 lots of data for asset A and asset B. X bar, notice there is the mean return for asset A, 5%. Down again, SX. Now, SX is the sample standard deviation for asset A, okay? And of course, that's what we computed manually. Now, we're going to need this because we're going to calculate covariance in a second. So what I'm going to do is I'm going to store that on button 1. So I've stored my 0.07 on button 1. If we keep on pressing down, you get sigma x, that's population standard deviation, irrelevant in this case because we're looking at a sample of data. Press down again, you get y bar, so this is the mean return on asset B, 7%, as we computed earlier. SY, sample standard deviation for asset B, so that's 11%. I need that data as well, so I'm going to store that on button 2. Okay, so STO and 2. I'm going to keep on going through my data. There's population standard deviation for the second asset, again irrelevant. You then get A. Now, A would be the intercept of a regression line between when you plot the data for asset A and asset B. B would be the gradient of your regression line. And then finally, R is the correlation coefficient. Now, of course, correlation coefficient is a standardized measure of how two assets vary together. If their returns move perfectly symmetrically with one another, then you're going to get a correlation coefficient of +1. If the assets' returns are perfectly negatively correlated with one another, then they're moving perfectly inversely with one another. And an answer close to 0 means essentially you've got no relationship between your two variables. Here we've got an R of 1, a correlation coefficient of 1. So it's saying these two assets' returns move perfectly with one another. So I'm going to store that on my button 3. Okay. Now, we're going to move on to covariance. I'm going to come back to my calculator in a second, and we're going to see that we've already got everything in our calculator that we need in order to calculate covariance. Okay, so let's have a look at how we calculate covariance. Notice how we compute it. We take the return of asset A, the first return of asset A, minus its mean return, the return on asset B, minus its mean return. So what we're doing is we're taking the deviation from the mean for both assets and multiplying them together. We do that for the second return. So there you are. There's your 2 there, minus the mean return on asset A. There's your -4. Again, you've got a choice if you want to do the computations manually. You can either do it as a decimal or you can do it as a whole number. I am actually, even though we've done it as whole numbers here, I'm a fan of doing it as a decimal. It's more mathematically correct, essentially, that way. And then you can see that there's the 12% and there is the 18%. So on the numerator, we're taking the deviation from the mean for both assets and multiplying them together and then summing for all observations. And then on our denominator, we're taking, again, n-1, number of paired observations -1. And that gives us a result of 77. Again, if we'd done it as a decimal, we would have got the more correct answer of 0.0077. Okay. And that is our covariance. Okay. So, again, you should be prepared to calculate covariance manually in the exam. Now, key point is we've got everything we need in our calculator to calculate covariance already. Because covariance, if you see down here, can be calculated as the sample standard deviation of asset A multiplied by the sample standard deviation of asset B times the correlation coefficient. So when we calculated it on our calculator, the sample standard deviation of asset A, 0.07, sample standard deviation of asset B, 0.11, and the correlation coefficient 7. Again, let me get my BA2 plus back on the screen. So if I clear this off now, if you remember, I stored sample standard deviation of asset A on button 1, sample standard deviation of asset B on button 2, and the correlation coefficient on button 3. So now I just need to do recall 1 times recall 2 times recall 3, press equals, and there you go. You can see the covariance there of 0.0077. Making sure you know how to use store and recall on your BA2 plus calculator. Make sure you can. It's really, really easy. You've got 10 memories that you can store data on. Okay, you know, if I want to store, let's say 966, I can choose any of the numerical buttons, including 0, to store it on. Let's say I store it on button, I'm going to store it on button 4. Okay. And if I want to get it back, so if I clear my calculator, if I want to get it back at any time, I just do recall and the button I stored it on. Do I need to worry about clearing out these memory functions? Not really in the exam. If you store something on a button, it will overwrite anything you've previously stored on it. Now, of course, I've had it from a lot of candidates in the past. They can't remember what they've stored on what button. Well, again, that doesn't matter. You can actually review it. If you go second function and number 0, and you see it says mem, and it's saying M0. It's telling me this is what I've got stored on button 0, nothing. And if I press the down arrow, it's M1 is what I've got stored on button 1. There's the 7% return on asset 1. M2 is what I've got stored on button 2. M3 on button 3. and 4 on button 4, etc. Okay. Now, if I did want to actually wipe out all of my memories, clear all of my memories, I can do that if I'm in this memory mode by doing second function and clear worksheet. Now, all my memory buttons have been cleared to 0. Okay, I just wanted to give you a demo there of how to use the memory function on the BA2 Plus, because again, when I'm delivering live classes, which of course is rare in this COVID world we now live in, number of candidates that I see writing down big strings of digits, and that just tells me that they don't know the functionality of their BA2 Plus. Okay, so in other words, to calculate covariance when you've got 2 assets in the exam, then essentially you can calculate the sample standard deviation of the first asset, the sample standard deviation of the second asset, and the correlation coefficient, multiply them together, and you've got covariance. Now, the one calculation that the BA2 Plus cannot deal with is when you have 2 assets and probabilities. So you get a probability matrix, and that's actually touched on in quant. And the reason the BA2 Plus can't cope with that calculation is it's only got functions for X and Y. And if you've got 2 assets and probabilities, you'd need X, Y, and Z. So you need to do those computations, unfortunately, manually in your quantitative methods area. But here, when we're looking at historical data, we can do it all to calculate our covariance on the BA2 Plus. Okay, so fantastic. So there's our covariance. Notice this is actually what they write in the syllabus. They actually write the correlation coefficient. Now this is population correlation coefficient. So they use the population value, but actually they mean sample correlation coefficient, and we use small r for that. And they say take covariance of your 2 assets and divide by the product of the standard deviations. Okay, so in other words, we just calculated covariance of 2 assets as essentially standard deviation of asset A times standard deviation of asset B times their correlation coefficient. So rearrange that, and again, rearrange that essentially, and again, if I use population correlation coefficient, there we go. That doesn't look very clear. Let me just make it clearer. There we go. Okay, so that's what we just did. Only we didn't use population values, we used sample values. So it's a bit confusing here when you look at the syllabus, because they actually use the population values. What they really mean is sample values. So essentially, if we take the covariance of asset A and B and divide by the sample standard deviation of asset A times the sample standard deviation of asset B, we get the sample correlation coefficient. Okay, so in other words, don't get put off by the fact that the author of the CFA book rather erroneously put in the population symbols for standard deviation when actually they meant to use sample standard deviation. Now, as I said, in this situation, we've got a correlation coefficient, a standardized measure of how 2 assets vary with one another of 1. Remember, our covariance here is not a standardized measure of how 2 assets vary with one another. It's an absolute value. Now, because it's an absolute value, theoretically, covariance can range from negative infinity up to positive infinity. Therefore, it's very difficult to interpret it. When I look at this covariance here, all I can say is, oh, look, it's a positive value. So the 2 assets returns vary broadly somehow positively with one another rather than inversely with one another. But it's very difficult to interpret the strength of the relationship simply by looking at covariance. So therefore, we take that covariance, we divide by the product of the standard deviations, and we get our correlation coefficient, sample correlation coefficient, which is our standardized measure. And remember, that measures that's a value between +1 and -1. +1 if the returns perfectly vary with one another, -1 if they're perfectly inverse, and 0 with no relationship. Oh. Someone's child in the background. Not me. I've locked my children away. Okay. okay, let's talk about risk aversion. So we've talked about correlation. It's going to come up again in a minute when we start to look at the work of Harry Markowitz. Before we get to that, we need to talk a little bit about risk aversion. We talk about investors as being risk averse. Now, first of all, what you need to know is what that doesn't mean. What it doesn't mean is they avoid risk, okay? What it does mean, essentially, is that in order to take on more risk, they need a reward. And that reward, of course, is additional return. Now, different investors have different levels of risk aversion. And that just simply means that they have different required increases in return for taking on a 1 unit extra risk. Okay, so notice risk aversion means investors prefer less risk to more risk. So what that is telling us is if we were to have two assets with identical expected returns, the investor would always choose the asset with the lower standard deviation, i.e. risk. And remember, we use standard deviation as our risk measure, as it measures the deviation of returns around the mean. So in other words, two assets with the same expected return, always choose the one with the lower risk. Alternatively, another way of considering this risk aversion, if two investments have equal risk, investors prefer the one with the highest return. So two assets with the same risk, always choose the asset with the highest return. So there is that key point that I made. We do not, as a risk-averse investor, attempt to minimize our risk. All risk aversion is telling us is, hey, look, if we take on risk, we need to be rewarded by higher return. Okay. Now, how do we measure an investor's attitude to risk? Well, we do it by looking at indifference curves. And typically what an indifference curve has is expected return on this axis and risk as measured by standard deviation on this axis. So if an investor has relatively steep indifference curves, and they're called indifference curves simply because an investor is indifferent between any investment that lies on a curve. In other words, they gain the same utility from any investment that lies on the indifference curve. The phrase utility, it's that kind of strange economic phrase that comes up a bit in microeconomics, doesn't it? Utility means happiness or benefit or well-being, if you like. So we get the same happiness level for any investment on the same indifference curve. Now, notice what the indifference curve is showing us. It's showing us for a change in the x-axis, how much change in expected return we require. So for a change in risk, how much change in return do we need? And as I said, the steepness of the indifference curve therefore measures the level of risk aversion for the investor. The more risk averse you are, the steeper your indifference curves will be, because you'll want more return to offset an increase in risk. Let's look at an investor that's less risk averse. Shallower curves. So now, for a similar level of change in risk, this investor requires a smaller increase in expected return. So basic rule for our exam is the more risk averse an investor is, the steeper those indifference curves are. Okay, and we make an assumption in modern portfolio theory that all investors are risk averse. All investors require an increase in return for taking on more risk. Now, of course, in the real world, that's not the case, because gambling would not exist if people were totally risk averse. So in fact, in the real world, some people are risk loving. Okay. Lovely. Okay, so I'll give you just 30 seconds or so to consider that question. So think of that question and see what answer you arrive at, and then we'll chat it through. Okay, so Abner is risk averse. Which of the following statements is most likely correct? He will choose relatively safe investments. No, that's not what risk averse means at all. It means you may well take on risky investments, but you will require a higher return on those risky investments. He may hold some very risky investments. Yes, that's true, but if he does, he'd want a very high return on them. His risk tolerance is relatively low. No, that's not what risk aversion means. Risk aversion is the trade-off between risk and return, okay? Which, of course, oh, sorry, Patrick, I saw a statement come in from you, clicked on the screen and disappeared off. I will answer all of the questions at the end, because actually I can't answer them as I go along because I can't look at the slide and the questions coming in simultaneously. So I do promise to go back and at the end of the presentation answer any questions that have come in. Okay, so let's have a look. His risk tolerance is relatively low. Might be, might not be, who knows? Your risk tolerance is how much risk you are willing to take. Now, you could be risk averse, but willing to take a lot of risk just means you need a lot of return. So I think the only statement we can say that is actually correct, or what actually is not obviously wrong, is statement B. Okay, and thankfully it is. Now, here we go into the seminal work of Harry Markowitz. Okay, this is Harry Markowitz. In 1952. The significance of this was Markowitz said, when you're considering adding investments to your portfolio, you shouldn't just look at the assets' risk and return. What you also need to consider is its covariance. Okay, how its covariance with your existing portfolio. In other words, Markowitz gave us a framework for considering how non-correlated assets, by combining non-correlated assets, we could diversify some of the risk in our portfolio. Now, in the level 1 exam, we are only expected to use the Markowitz formula for 2 asset portfolios. This formula can be extended for as many assets as you like. And let's just talk about the formula on the first of all that we've got here. So this is variance, square root variance, and of course you get the standard deviation of your formula. So this is how to calculate the variance of a portfolio containing 2 risky assets. So notice we take the variance of the first asset, okay, rather than standard deviation. So variance of the first asset times the squared weighting of the first asset plus the variance of the second asset times the squared weighting of the second asset plus 2 times the weighting of the first asset times the weighting of the second asset times their covariance. Now, this is a formula that you are going to need in the examination. You know, I remember when I first encountered it, and I actually first encountered it in my undergrad, my econ undergrad, many, many moons ago, as you can tell by the volume of grey hair I now have. But I remember thinking, I'll never remember this. Now, I don't even need to look at it. You know, I just know, oh yeah, variance of the first asset times squared weighting of the first asset plus variance of the second asset times squared weighting of the second asset plus 2 times the weighting of the first asset times the weighting of the second asset times their covariance. Boom. Okay, it will become second nature to you. It needs to become second nature to you. And of course, the only way things become second nature is via question practice. Okay, so really, key way of passing the exam and making the exams, CFA exams, are not that difficult is huge volumes of question practice. It beats everything else you can do, including listening to me. Okay. So squared weighting of the first asset times the variance of the first asset, squared weighting of the second asset times the variance of the second asset, plus 2 times the weighting of asset 1 times the weighting of asset 2 times their covariance. Now, believe it or not, I have been asked in the past, how do I know which is the first and which is the second asset? Totally irrelevant, of course, to doing the computation. Doesn't matter, just choose one. Okay, now you can see why, if you think about it, you can see why the formula gets more complicated for 3 assets and beyond. Because if I was looking at 3 assets, okay, and it's worth being aware of this because we do touch on it briefly at level 2. If I was looking at a 3 asset portfolio, I would have the squared weighting of the variance of asset A times the squared weighting of asset A plus the variance of asset B times the squared weighting of asset B plus the variance of asset C times the squared weighting of asset C. But then this is the bit where things start to get a little bit more complicated as you add assets. I would need to look at 2 times the weighting of asset A times the weighting of asset B times the covariance of asset A and B. But then I'd need to look at 2 times the weighting of asset A times the weighting of asset C times the covariance of asset A and C. And then finally, I need to look at 2 times the weighting of asset B times the weighting of asset C times the covariance of asset B and C. So as a result, the number of covariants starts to rise exponentially as you add assets to the portfolio. So rather beautifully at level 1, we are only concerned with using the Markowitz formula to work out the variance of a portfolio with 2 assets. Now, examiner can make it a bit trickier on you. He doesn't tell you the covariance of asset A and B, but instead he gives you their standard deviation. Okay. Now, if he's giving you the standard deviation of asset A and B, then of course all you need to do is take the correlation coefficient multiplied by the 2 standard deviations to calculate the covariance. So he can be a bit tricky and give you correlation coefficient rather than covariance, in which case take that correlation coefficient, multiply out by the product of the standard deviations to get your covariance. Okay, now of course all we then need to do if we're asked the standard deviation of our 2 asset portfolio in the exam is divide this by 2. This formula has got a very high chance of being tested. It was seminal work. This was absolutely critical. Beforehand, whilst we knew diversification of risk was important, we hadn't got the mathematical structure to analyze how assets, when combined in a portfolio, reduce the risk of the overall portfolio. So very important in the development of modern portfolio theory. Right, okay then, guys. So we're told that the portfolio is 30% invested in stocks, and they've got a standard deviation of 20%. The remainder is in bonds, so 70%, with a standard deviation of 12%. And the correlation of bond returns with stock returns is 0.6. And we're asked what is the standard deviation of portfolio returns. Okay, I will give you I'll give you a minute and a half like you'd have in the actual exam, and I'd like you to have a go at calculating here the standard deviation using your Markowitz 2 asset portfolio formula from the previous slide. Okay, so have a go at doing it. Okay, so that's probably enough time on that. So, okay, so we've got 2 risky assets here, stocks and debt, and we want to calculate the standard deviation of the portfolio. So we're going to need to take the variance, but notice we've got standard deviation. Okay, so in our computation, we're going to need to use 0.2 squared, And of course, we use squared weighting as well. So that's going to be 0.3 squared. For our bonds, again, we're going to need to use 0.12 squared as their variance. And we're going to need their weighting as 0.7 squared. Okay, 70%. So there you go. So there's our first asset. 20% is the standard deviation. So we're squaring that to get variance. And we multiplying that by the squared weighting. So 30% squared. Second asset has a standard deviation of 12. So variance 0.12 squared times the squared weighting. Then, because we haven't been given covariance, but we have been given the correlation coefficient, then we're going to do 2 times the weighting of asset 1 times the weighting of asset 2 times the correlation coefficient times the product of the standard deviations. So standard deviation of stocks, 20%, standard deviation of bonds, 12%. Remember, by doing this, by multiplying the correlation coefficient with the product of the standard deviations, that is giving us the covariance of our stocks and bond portfolio. Okay, now, of course, what you then need to do once you've got your answer there is square root it to get your portfolio standard deviation. I have to say, when I was using the BA2 Plus to do these type of computations, and let's get it up there again, for something like this, I would often use, break it down into various chunks and use my memory functions. That way, if I did kind of mess something up, I didn't have to go right back to the beginning of the question. So 0.2 squared times 0.3 squared equals, and there we go. That is that little computation. Whoops, that little computation there. Let me get my BA2 Plus calculator back on the screen. There it goes. So I'm going to store that on button 1. I'm going to do exactly the same for the second asset. So 0.12 squared times 0.7 squared. So that's my bonds in my portfolio. Store that on button 2. Then I just need to do twice the weighting of the first asset times their covariance, and their covariance is 0.6 times 0.2 times 0.12 and press equals, and there you go. There's the third term. So I'm going to store that on button 3. Now all I need to do is add them together. So recall 1 plus recall 2 plus recall 3 equals. So there is the covariance of the portfolio, or the variance of the 2 asset portfolio, I should say. We're asked for standard deviation, so I just need to square root that. And there is the 12.9%. Okay, obviously as a decimal. Lovely. So likely to be asked to do something like that? I would say very, very likely in the exam. So make sure you feel comfortable on this formula. Now, here's a little shortcut, but it only works when the correlation between 2 assets is perfectly positive. Okay, notice to do this, if the correlation of the 2 assets is perfectly positive, I can just take the weighting of the first asset times its standard deviation and add that to the weighting of the second asset times its standard deviation. It only works when the 2 assets are perfectly positively correlated, and it works because there is no diversification benefits of combining assets that are perfectly positively correlated. So watch out for that. If they give you assets and the correlation coefficient is +1, think, well, hey, I don't need to use that nasty formula. I can just weight each of the standard deviations and simply add them together. Now, why are we so interested in correlation? Now, of course, correlation, the idea is if we combine assets that are not perfectly positively correlated, we can reduce risk. So I've got asset A and asset B there. Let's start with this point here. This represents 100% of my wealth invested in asset B. Now, if I reduce the proportion of my wealth invested in asset B and increase the proportion of my wealth invested in asset A, then essentially all that will happen is I move up to a point where eventually I've got 100% of my wealth invested in asset A. Now notice in this situation, you've got a straight line joining them. And that's because these two assets are perfectly positively correlated. And if you've got two assets that are perfectly positively correlated, if you combine them within a portfolio together, okay, you don't get any risk reduction benefits. So notice, as I increase the proportion of A in my portfolio, then the return, expected return on my portfolio is rising, but so too is the portfolio's risk. Now, let's imagine that these two assets are not perfectly positively correlated. Let's imagine they've got a correlation of positive 0.3. So they're still positively correlated, so their returns move in the same direction, but it's now not a perfect relationship. Now notice, this is the important thing. As I reduce the proportion of my wealth in invested in asset B, so I'm decreasing the proportion of my wealth invested in asset B and increasing the proportion invested in asset A. Notice the expected return is going up, but very critically, the risk is going down. Now, the thing you need to take away from this in the exam is as long as assets are not positively correlated, then some risk reduction is possible. Okay, now the bigger the negative correlation between two assets, the better the risk reduction will be. But what a lot of candidates misunderstand is they think assets need to be negatively correlated to benefit from risk reduction when you combine them in a portfolio. That's not true. As long as they're not positive one in terms of the correlation coefficient, then some risk reduction is possible. Okay. Now notice essentially that there's a point there for a combination of asset A and B here that will minimize the risk of your portfolio. If you go beyond that, then essentially all we're going to do is end up increasing expected return, but actually increasing risk at the same time. Now, if the correlation between the two assets, let's say, was minus 0.3, then notice our bow gets bigger. In other words, the amount of risk we can diversify without reducing return, and in fact, we're actually reducing risk at the same time as increasing return, is bigger. So the closer we get to perfect negative correlation, the better the risk diversification we have when combining assets. Now, if we had two assets and they were perfectly negatively correlated, then there would be some combination of those two assets that could completely eliminate risk. Remember, if they're perfectly negatively correlated, then their returns are moving inversely with one another. Okay. Now, there is therefore some combination, and it's not necessarily 50-50 that could totally reduce risk in your portfolio, reduce the standard deviation down to 0. Okay, so again, key things to take into the exam. Number one, as long as assets are not positively correlated, some risk reduction is possible. If two assets were perfectly negatively correlated, then it would be completely possible to eliminate risk. Okay, but in reality, you're not likely to find assets that are either perfectly positive or perfectly negatively correlated. So in practice, when we're constructing portfolios, we're trying to combine assets that have the biggest negative correlations that we can find. Okay, the bigger the negative correlation, the better the risk reduction diversification will be. And remember, diversification is all about reducing risk without reducing return. In fact, we can see here, we reduce risk at the same time as increasing return. Okay, so a little question. Again, I'll give you a wordy question, so I'll give you 30 seconds or so to read that and then come up with one of your answers. Okay, let's take a look at that together. Now, of course, in the real exam, you get 1.5 minutes per question. So I'm speeding you along here. An asset has correlation with a portfolio's return that is less than 1. I see that, immediately I'm thinking, good, if I include this asset in my portfolio, it will reduce my portfolio's risk without necessarily reducing its return. Okay, but it says it has the same standard deviation of returns as the portfolio. So I'm going to combine an asset that has the same risk as my existing portfolio, but it's not positively correlated. What is the most likely effect of adding some of this asset to the portfolio on portfolio risk? Okay, now, of course, a weak candidate will say, well, hang on a second, I'm combining an asset that has the same risk as the existing portfolio, and therefore my portfolio will be unaffected. But that's not true, because of the less than perfect positive correlation. So when I combine an asset that has the same risk, but it is less than perfectly positively correlated with my existing portfolio, overall my portfolio risk will decline. So we're looking for a decrease. Right, okay, so let's take it on. What did Markowitz then do? Well, we need to be able to explain the Markowitz minimum variance frontier and the Markowitz efficient frontier. Now, notice, what we first of all do in order to construct this is we need to form our capital market expectations. Now, what do we mean, capital market expectations? We mean expectations of assets risk, expected return, and correlations between assets. Now, when we're looking at CAPM, we talk about individual assets, individual equities, individual debt securities, etc. So we would need each individual asset's risk, return, and correlations with other assets. Now, major issue in practice is if you were to do that, think of the number of correlations you would have if you were looking at individual securities. So we tend in the real world not to use individual securities, we tend to use asset types. Okay, in other words, things like large cap equity, mid cap equity, small cap equity, government bonds, high yield bonds, investment grade bonds, etc. So we'll look at types of assets. So the return on that type of asset, that type of asset's risk, and the correlations between asset allocations, asset types. Okay, now, once you have got the standard deviation for your assets, the expected return on the assets, and the correlations over the next period, remember these are all forecast values. What we're then going to do is use a computer to compute what we call our minimum variance frontier. So what you do is you set an expected return. Okay, let's say there. Actually, I'm going to put some dots on it. There you go. Let's take this asset. So we set an expected return there. We then use our computer and we use. Oh, I think someone's knocked themselves off mute. Okay, so we set an expected return, and then we use our computer to work out all portfolios or all combinations of securities, or asset types in this case, that would generate that expected return. We then choose the portfolio that has the lowest level of risk. We then increase our expected return. And we run our computer program again. We look at all combinations of assets that would generate that expected return, and we choose the portfolio with the lowest level of risk. And we move our expected return up again. Again, we look at all portfolios that could generate that, or all combinations of risky assets that could generate that expected return, and we choose the one with the lowest level of risk. Okay, now notice there is one portfolio here at this level of expected return that has the lowest risk of any portfolio. And we often refer to that as the minimum variance portfolio. So we're going to just keep on doing it. All we're going to do is we're just going to keep on setting expected returns and then using our computer optimization program to work out which combination of assets could generate that return at the lowest level of risk. Now, once we've done that, we can join them up with a line, and that line is known as the minimum variance frontier. It shows all portfolios that generate an expected return at the lowest level of risk. Okay, there's our global minimum variance portfolio, as we mentioned. Inefficient portfolios, we could choose these portfolios, but we never, in fact, in practice, would. How many assets? Oh, good question about the benefits of diversification. How many assets do you need to include to diversify away a lot of your risk? I will come to that question in a little while, okay? Because we're actually going to touch on that within the syllabus. Theoretically, in order to totally eliminate risk, or to eliminate what we call systematic risk in your portfolio, you would need to hold what we call the market portfolio, and I'll explain that in a second. Now, notice that portfolios within the minimum variance frontier are inefficient. Now, why are they inefficient? Let's just choose a random portfolio. Let's use this one here. It's inefficient because if I held a portfolio up here, okay, it would be generating a higher expected return for the same level of risk. Okay. Likewise, this portfolio here, it's inefficient because if I held a portfolio up here on the minimum variance frontier, it would be generating a higher return for the same level of risk. Okay, so therefore, the conclusion is the investor would never hold an inefficient portfolio. Why? Because we make the assumption they're risk averse. You always choose the portfolio that generates the highest return for a given level of risk. Okay. Unattainable portfolio, so in other words, a portfolio out here, not possible to achieve. Okay. Oh, I think Victor, I think you've jogged yourself off mute. Lovely. Okay, so I've now got this green line that I've put on here. This is known as the efficient frontier. Okay, and when we say efficient frontier, we're talking about Markovit's efficiency. Markovit said investors would only ever choose risky portfolios that lie on the efficient frontier. Okay, so even though this portfolio here is on the minimum variance frontier, it's still inefficient because, again, by choosing a portfolio up here that lies on my efficient frontier, I'm getting a higher expected return for the same level of risk. Therefore, risk-averse individuals will only ever choose risky portfolios on the efficient frontier. Okay. Now, let's see, therefore, again, I'll give you a minute or so on this particular question. Have a look at that question and see if you can tell me, which of those portfolios is least likely to be on the efficient frontier. Okay, I see a few of you punching in some answers. Now, when you look at this, there's only one asset that really leaps out of you as being clearly not on the efficient frontier. And that essentially is B. Why? Because it has a lower expected return than asset C, but more risk. You'd never therefore choose asset B over asset C. Remember, if you are to take on more risk, you need a higher return. So when I look at asset A and compare that to asset B, I can't tell whether B is inefficient or not because B has more expected return but more risk. But when I compare B to C, then I can tell that B is inefficient because it's got a lower return and more risk. So B, all of you that said B, that's completely correct. That could not be on the efficient frontier because essentially it has lower return and yet more risk than asset C. Lovely. And that's the kind of questions that you get in portfolio management, questions a bit like this. Right, okay, there is our minimum variance frontier. What I've done is just sketch the minimum variance frontier. The efficient frontier, remember, if I put that line there, really is the red line above that little horizontal line that I've put. Now, what we're then doing now is we're moving away from the work of Markowitz and the efficient frontier, all of that was Markowitz, and we're going to now introduce a risk-free asset. Now, once we do that, we're moving to the work of Trainer and also Sharp. Pretty much they both came up with this at the same time. And as I said before, this is 1964. What we're doing is we're going to start marching towards the capital asset pricing model in a second. So notice what we're going to do is we're going to add a risk-free asset. Now, key thing with a risk-free asset is its standard deviation is 0. It's risk-free. Okay, so it has a 0 standard deviation. That's a terrible attempt at writing standard deviation. There we go. That's a bit better, isn't it? It has a standard deviation of 0. Okay. Now, what we're going to do is add the risk-free asset in. Now, something interesting happens at that point. When you add a risk-free asset, there's my risk-free asset. That's its, you can see standard deviation of 0. Now, what I'm going to then do is give investors a choice between choosing a risky portfolio on the minimum variance frontier or the risk-free asset. Okay, now that gives me CALA. CAL, what does that stand for? It stands for Capital Allocation Line. Okay, so what I'm actually doing is I'm giving investors a choice between risky portfolio A here that contains risky assets or a risk-free asset, combinations of the two. Okay, and that gives me capital allocation line A, but I could choose portfolio B. Okay, then I'm giving investors a choice between risky portfolio B or a risk-free asset. Okay, I get capital allocation line B. And then finally, risky portfolio C and the risk-free asset. That gives me capital allocation line C. Now, the key thing to note here is investors will always choose to be on the highest capital allocation line that they can achieve. Okay, why? Because the gradient of the capital allocation line is the Sharpe ratio. And the Sharpe ratio is the return on your portfolio minus the risk-free rate over the standard deviation of your portfolio. Okay, I think you first see that in quants. Now, what we've got therefore on our numerator is excess return, and we're dividing it through by standard deviation of the portfolio. So what the Sharpe ratio tells us is excess return per unit of risk. Now, if you are a risk-averse investor, by definition, you will always want to choose the highest Sharpe ratio. You will always want to maximize the excess return a portfolio generates per unit of risk. So therefore, rational risk-averse investors will choose a combination of the risk-free asset and risky portfolio C. Okay, and notice where we have our risky portfolio C, it's a tangents. So if we take our risk-free asset and draw a straight line, we get a tangency point with our original minimum variance frontier. And that is known as the optimal risky portfolio. Sometimes we refer to it as the tangency portfolio. Okay, so that is the optimal risky portfolio. Okay, what do I mean optimal risky portfolio? Well, if you combine combinations of the risk-free asset and this optimal portfolio of risky assets, you will find that you're on the highest capital allocation line, and therefore you have the highest Sharpe ratio, and therefore you're maximizing excess return per unit of risk. Okay, so as we said, look, once we've got an efficient frontier, there's our minimum variance frontier. We've added in a risk-free asset. Okay, so we get our tangency portfolio on there somewhere. How do we know? Oops, sorry. how do we know what portfolio the investor will choose? Now, the idea is you can choose any portfolio along the capital allocation line. Let's put our tangency portfolio on there. There we are. I'm going to call that my optimal portfolio of risky assets. Okay. Now, to work out what combination of risk-free borrowing and lending and investment in the optimal risky portfolio an investor would choose, only way we can do that is to plot the investor's indifference curve. So let's put the first indifference curve. So this is investor A, okay, and they choose this combination here. Now this is a choice or a combination of risk-free lending and investing in the optimal portfolio of risky assets. The idea is if you invest in the risk-free asset, that's lending at the risk-free rate, overall it will reduce the risk of your portfolio. So given the shape of this investor's indifference curves, he would choose portfolio A, which is a combination of risk-free lending and the optimal portfolio of risky assets. Now, investor B here has much shallower indifference curves. Now, remember, that means they are less risk averse than investor A. And as a result, they choose portfolio B. Now, this point here, the optimal risky portfolio would represent 100% of wealth invested in risky assets. So portfolio B actually represents more than 100% of your wealth invested in risky assets. How can we do this? Well, not only can we lend at the risk-free rate, we can also borrow at the risk-free rate. So portfolio B here is a leveraged portfolio. This individual has borrowed at the risk-free rate and invested more than 100% of their wealth in the optimal portfolio of risky assets. Okay. So notice, therefore, built into our assumptions here is you can borrow and lend at the same risk-free rate. Now that, of course, in practice is not really true, is it? When you tend to borrow, you pay a higher interest rate than when you lend to a bank. And of course, that spread is how deposit-taking institutions, loan makers, deposit takers, make their profits, of course. Now, all that would mean is that you would get a kink in your capital allocation line, essentially. Because leveraged portfolios, you'd be paying higher interest on those and generating a lower return. Right, okay, so let's have a look at this question. The set of portfolios on the minimum variance frontier that dominates all sets of portfolios below the global minimum variance portfolio is the... So set of portfolios on the minimum variance frontier that dominates all sets of portfolios below the global minimum variance portfolio is the... Well, the answer is going to be the Markowitz efficient frontier. Okay, let me go back and show you why. Just in case you were worried, I'll just go back a couple of slides, sorry. Okay, let's go back to this. Let's get rid of my ink. Those are your minimum variance portfolios, and there is the global minimum variance portfolio. Remember what we said, essentially, you would never choose any of these portfolios, even though they're on the minimum variance frontier, because they are inefficient. You never choose anything that plots below the efficient frontier. Okay, and that efficient frontier is our green line, and notice it starts off at the global minimum variance portfolio. Okay, I'll skip forward now, just back to where we were. Okay, so key point therefore is the set of portfolios on the minimum variance frontier. Okay, so it said minimum variance frontier. That's how I knew I was looking at the minimum variance frontier, and therefore the efficient risky asset portfolios on that, which are given by the efficient frontier. Okay, Markowitz efficient frontier. Capital allocation line wasn't right. Why? Because we need to add a risk-free asset to get our capital allocation line, and it doesn't mention any risk-free assets, and it's talking about the minimum variance frontier, which only considers risky portfolios. Okay, remember when we're constructing those minimum variance frontier, we're looking at assets returns, assets risks, and covariances or correlations for all risky asset types. Okay, haven't introduced a risk-free asset at that stage. Set of optimal risky portfolios. Well, it's not necessarily optimal. Okay, there is going to be one optimal portfolio, and that comes when we add a risk-free asset. Then we get our tangency portfolio. To work out what risky portfolio is optimal for an individual investor without a risk-free asset, how would we do that? Well, again, I'll show you on the previous slide. I'm just going to wipe away a bit of this. So if I want to know, let's assume there's no risk-free asset in this marketplace, and you want to know what portfolio your investor would choose on the efficient frontier, you plot their indifference curves. Okay, and maybe I get an indifference curve that does something like that. And therefore, I say for this investor, that is the efficient risky portfolio that they would choose. Okay. Lovely. So the answer is the Markowitz efficient frontier. And you can see that question comes from the CFA Institute itself. Lovely. Okay, so we've done a bit of our basic modern portfolio theory. I'm going to take it a little bit further now. Now, combining risk-free and risky assets. Again, you might be asked to compute the expected return on a combination of risky and risk-free asset portfolio, and you might be asked to calculate the standard deviation. Now, this is quite straightforward. Working out the portfolio's expected return, it's just a weighted mean. So you take the weight, you know, let's say the risky portfolio is 60%. So I'd take 0.6 times its expected return. Let's say, I don't know, I'm going to say 12%, so 0.12. And of course, if 60% is invested in the risky portfolio, then I'm investing 40% in the risk-free portfolio. Let's say that's got a return of 3%. Okay, so I can work out my portfolio expected return very easily. 0.6 times 0.12, that's 7.2%. 0.4 times 0.3, which is of course 1.2%. Add them together, and I'm actually going to get, whoa, not that. Let's try again. 0.6 times 0.12, 7.2, that's right. 0.4 times 0.03, that's better. Or 2, I think I did 0.3 rather than 0.03. Okay, and I get from that 0.084 or 8.4%. So working out the portfolio expected return, very, very easy. Now, working out the portfolio standard deviation is a gift. And I've seen candidates before that have come out of that CFA exam and said this was not possible because they did not tell me the correlation between my risk-free asset and my risky portfolio. So I couldn't use the Markowitz two-asset portfolio formula that we saw earlier. To which I almost want to put my hands in my head in my hands and just say, well, look, by definition, your risk-free asset has a standard deviation of 0. Okay, it doesn't vary. Okay, by definition. So the correlation between the risky portfolio and the risk-free portfolio is always 0. Okay, so the portfolio standard deviation we can compute very simply by taking the weighting of our risky asset times the standard deviation of the risky portfolio. You don't need to consider the risk-free asset. Okay, there's no diversification benefits. Sorry, there are diversification benefits, but there's no correlation between, your correlation is 0 between your risk-free asset and the risky portfolio. Okay, so let's have a look at this. So we've got our expected return. So this represents 100% risk-free lending. And this represents 100% invested in the risky portfolio P. Okay, here's our portfolio with 50% in the risk-free asset and 50% in the risky portfolio P. Okay, well, of course, it's just going to have, using this formula here, we're just doing 0.5 times the standard deviation of the risky portfolio, which of course is the same as saying take the standard deviation of the risky portfolio and divide by 2. Okay, so nice and straightforward if you're asked to do computations when you're combining a risk-free asset and a risky portfolio. Now, as we said, not only can we lend at the risk-free rate, we can also borrow at the risk-free rate. So here are three risky portfolios, C, B, and A, combining them with risk-free assets. And of course, we get 3 different capital allocation lines. Our investor would always choose capital allocation line A. Why? Well, we mentioned it before. It has the highest Sharpe ratio. Okay, the gradient of our line, if you want to think about it, the way we can calculate the gradient of our line is by taking the return on portfolio A minus the risk-free rate over the standard deviation of portfolio A. That is going to be the gradient of your capital allocation line. Okay, and remember, it's looking at excess return per unit of risk. I always want more return per unit of risk. Okay, and you can see, therefore, if I plot an investor's indifference curves, the indifference curve, the highest indifference curve, will be where we get a tangency with capital allocation line A. Again, assumption in our exam is you always want to be on the highest indifference curve as an investor because that will maximize your utility. Again, what does utility mean? Well, it's that kind of happy, joy feeling. It's happiness, contentness. We get more contentness or happiness by being on the higher indifference curve. Okay, and we can see why I get more happiness by being on the higher indifference curve, because that gives me a portfolio, a combination of the risk-free asset and risky portfolio A. Okay, again, remember what this represents. Therefore, it represents some proportion of risk-free lending. So some of my wealth is invested in risk-free lending, and some of my wealth is invested in risky portfolio A. Okay. And as I said, we want to be on the highest capital allocation line because it gives us the highest Sharpe ratio, excess return per unit of risk. Now, at the moment, we've been talking about capital allocation lines. Notice it says CAL, 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 capital allocation lines. And capital allocation line assumes heterogeneous expectations. Expectations of assets, risks, returns, and correlation. Okay, meaning when we go back and we plot that minimum variance frontier, the minimum variance frontier I compute will be different from the minimum variance that you compute and that somebody else computes, because we'll all have different ideas of assets, risks, returns, and correlations. Meaning we have different capital market expectations. We all construct a different minimum variance frontier. Now, when we talk about the capital markets line, and the capital markets line, when we look at the capital markets line, we're moving towards cap M, we assume homogeneous expectations. Now, this means all of our investors have identical attitudes to investments, risk, returns, and correlations. So what that means is you all generate exactly the same minimum variance frontier. All investors have exactly the same efficient frontier. And then when we throw in a risk-free asset, we all end up with the exact same optimal tangency risky portfolio. Okay, so everybody has the same efficient frontier. So when we add a risk-free asset, everybody comes up with this portfolio. And this portfolio is often referred to as the market portfolio. The reason it's referred to as the market portfolio is by default, it must contain all risky assets, okay? Because if a risky asset was not included in it, the demand for the asset would fall to zero, which means its price would come down relative to its risk, and then it would be worth holding in the market portfolio again. Now notice, therefore, to the left of the market portfolio, this represents combinations of risk-free lending and investing in the market portfolio. But as we said, we can have leveraged portfolios. Not only can we borrow at the risk-free rate, we can lend at the risk-free rate. So we can borrow and lend. So therefore, portfolios over here, let's say a portfolio up here, would represent borrowing at the risk-free rate and investing more than 100% of my wealth in the market portfolio. But the key is there is only one optimal risky portfolio which all investors will hold, and we'll call it the market portfolio. Okay. When we look at the real world, and investors have different expectations of risk, returns, and correlations, or at least fund managers have different expectations of risk, returns, and correlations, everybody has a different efficient frontier, so everybody comes up with a different tangency portfolio. Okay. Now notice, when we're assuming homogeneous expectations, rather than calling this a capital allocation line, we call it a capital markets line. Okay, so previous slide, we called it a capital allocation line because this is what a fund manager would use to allocate an investor's funds between a risky portfolio and a risk-free asset. Here, because we're assuming homogeneous expectations, it's not really about allocating investors' funds, and therefore we call it the capital markets line. Okay, so just be aware of those different definitions in words. You hear them saying capital markets line, you think, oh, this is very theoretical. This is assuming every investor has identical expectations of risk, returns, and correlations. Therefore, only one efficient frontier. Therefore, only one risky portfolio that's efficient. We'll call that the market portfolio. Good. Now, there's the linear equation for the capital markets line. The expected return on a portfolio is equal to the risk-free rate. Well, that's the intercept of our capital markets line. Of course, back on the previous slide, your capital market line, that blue line, it's linear, and notice there is its intercept. But of course, its gradient, just like a capital allocation line, is the Sharpe ratio. So notice we compute it as the expected return on the market minus the risk-free rate over the standard deviation of the market. And this, of course, is our X variable. So significance is, if I know a portfolio standard deviation, let's go back to the previous slide. If I now know a portfolio standard deviation, let's say we've got a portfolio standard deviation up here, what I can do is plot my way up here. And work out its expected return. Okay. And that, of course, so take a standard deviation, portfolio standard deviation, and work out its expected return. So that capital market line is just, in equation-wise, is just this. Intercept risk-free rate, gradient Sharpe ratio, and of course, the value on our x-axis is our x variable there. Now, notice what they're then going to do with this formula. They're slightly going to rearrange it. Only slightly, just going to swing that over there. And we then get the expected return on the portfolio is the risk-free rate plus the expected return on the market minus the risk-free rate times the standard deviation of the portfolio over the standard deviation of the market. This is known as the market risk premium. In other words, the premium that you get over and above the risk-free rate for holding the market portfolio. This, of course, over here is our portfolio risk relative to the market. So what we're going to do is we're going to take the market risk premium. If our portfolio that we're analyzing has more risk, then, of course, we're going to that market risk premium. Whereas, of course, if our market portfolio has less risk, then we're going to decrease it. So all we're going to do is take that market risk premium and increase it or decrease it according to the standard deviation of our portfolio relative to the standard deviation of the market. add the risk-free rate because that's our intercept, and that gives us our expected return on a risky portfolio. Right, now, what we then say is, there's a little bit of a problem with our capital markets line. And a little bit of a problem goes back to this being our measure of risk. We use standard deviation in the capital markets line. And of course, we know what standard deviation is. Deviation around expected return, or arithmetic mean, if you like. Now, standard deviation is total risk. And total risk is systematic. For some reason, I always think of the film Grease, you know, systematic, hydromatic, systematic, and unsystematic. Now, there's a problem if we're using this capital market line to work out the expected return on a portfolio for a well-diversified investor. Okay, because we're using standard deviation, and standard deviation is total risk, systematic, and unsystematic. Systematic is non-diversifiable risk. You cannot eliminate systematic risk. You can alter your exposure to it, how much you face, okay, but you can't eliminate it. Unsystematic risk, I look at UN for unsystematic, and I think UN for unique. This is unique risk, unique to the individual stock that you're looking at, unique to that particular asset type, if you like. The idea is unsystematic risk can be diversified away by holding a well-balanced portfolio. Okay, so let's return to our systematic. So notice, therefore, systematic, otherwise known as market risk, is key thing is non-diversifiable. That is not to say that all investments have the same level of systematic risk. They don't. They have different exposures, okay? But you can't totally eliminate it. Okay, well, not a long short fund anyway, but so let's not go into that. Okay, so we're caused by macroeconomic factors, typically big factors that affect all stocks in the market, things like interest rates, GDP growth, etc. Okay. And it says it's measured by the covariance of returns with the returns on the market, okay, on the market portfolio. So measured by the covariance of your stock against the market and comparing that with the variance of the market. We'll look at that in just a little while. This is really saying it's the covariance of the stock against the market. That is how we measure systematic risk. Now, I can almost hear you thinking, no, we don't. We measure it as beta. Now that essentially is just a different version. We'll come back to that in a second, okay? So this is our measure of systematic risk. Now, unsystematic, as I said, it's unique risk, idiosyncratic risk, some people call this, firm-specific risk. You know, so the key point is this can be diversified away by choosing a well-diversified portfolio. And in fact, if we want to get back into the kind of theory of the capital asset pricing model, if we hold that market portfolio, because it contains all risky assets weighted according to their market caps, it has no unsystematic risk at all. It's perfectly diversified. In practice, though, we don't need to hold every single stock in the market weighted to its market cap. We don't need to hold the market portfolio. The empirical evidence seems to suggest once we choose between 50 and 30 well-chosen stocks, okay, so not just random picks, well-chosen securities, we can eliminate the vast majority of unsystematic risk. Now, what does it mean, well-chosen securities? It must mean we're choosing securities that have low correlations, okay? So in other words, an investor can diversify away unsystematic risk without damaging expected return. That's the key thing we saw with correlations early. You can eliminate risk without affecting expected return. So if we can eliminate this risk without damaging our return, it makes sense that we get no reward, okay, for this risk. If you can diversify it away, why on earth would I give you a reward in terms of expected return? So CAPM is going to argue the problem with our capital markets line is it's rewarding us for both systematic and unsystematic risk, and therefore it is not applicable to a well-diversified investor. If you've got a well-diversified investor, they're not exposed to unsystematic risk, so we should only be rewarding them for the systematic risk exposure because they've eliminated unsystematic risk. And that takes us towards the capital asset pricing model. Okay, so what we've got on here on our y-axis is risk, so systematic and unsystematic. And remember, we said total risk is unsystematic and systematic risk. And what we've got on our y-axis is the number of securities in the portfolio, number of different securities. That's a key point there, okay? Now, we're going to start, there we go, we're going to talk about that being market risk, systematic risk, and this being unsystematic risk. I always used to teach my classes and say, imagine that you've got 100% of your wealth, 100% of your wealth invested in a hotel. Okay, invested in a hotel, and that hotel is on the top of a cliff. Okay, probably not the best example for you guys in the Netherlands. I guess you don't come across too many cliffs. Okay, but you've got a hotel, it's on a cliff, that cliff is eroding. Now, you've got a lot of unsystematic risk, unique risk for that hotel, because if the cliff erodes and the hotel falls into the sea, you've lost your investment. So you decide, okay, I'll split my portfolio. I'll invest maybe 50% of my portfolio in the hotel on the cliff and 50% of my portfolio in an inland hotel. So one that isn't subject to cliffs eroding. And I've reduced some of the unsystematic risk. I've now eliminated some of the unsystematic risk relating from the hotel on the cliff. But let's say that these two hotels are both in the same seaside town. Okay, so I've still got exposure to that seaside town. So I think, okay, well, I'll invest in some hotels in some other locations. Okay, but let's say that these hotels are still all in the Netherlands. So I choose to invest in some hotels in the Netherlands and in the UK. And I'm eliminating some unsystematic risk now relating to the Netherlands hotel industry. But I'm still exposed to the hotel industry overall and its unsystematic risk. Okay, of course, look, you're seeing a lot of unsystematic risk in the hotel industry right now due to COVID. So I think, all right, well, I'll also invest in some fintech stocks. Maybe invest in some Amazon, something like that. That will reduce some risk. Or I'll invest in some companies that produce semiconductors. Or maybe I'll invest in some companies that produce agricultural products. And what you'll notice, therefore, as the number of different companies that we're investing in increases, we are eliminating that unsystematic risk. Okay, so unsystematic risk is getting smaller and smaller and smaller and smaller until, and this is a kind of rather magic number from the CFA Institute, if we choose between 50 and 30 well-chosen stocks, okay, stocks with negative correlations, we should be able to totally eliminate the unsystematic risk. Now, theoretically, to totally eliminate your unsystematic risk, theoretically, you should hold the market portfolio. Okay, so again, remember empirically relative to theoretically. So theoretically hold the market portfolio, which contains all risky assets, but in practice, empirically, observationally, 30 well-chosen securities can eliminate the majority of unsystematic risk. The key point, though, is because it can be eliminated without affecting return, the investor does not require a return for it. The systematic risk, the risk caused by market factors, things like GDP growth, inflation, interest rate risks, exchange rate risk, with market risk, okay, and that is our systematic risk. So therefore, what Sharpe essentially said was investors should only get rewarded for systematic risk. Okay. Now, that takes us on to the market model. This is a linear regression model. Okay, so it's a regression model. If you're not that comfortable about regression, don't worry. You don't really need to know much about regression at level 1, but we will be covering it in more detail at level 2. So we've got the return on our stock as an independent variable. This is our intercept term. this is our slope coefficient, and this is our dependent variable. Okay, so what we're really going to do here is we're going to look at a regression. We're going to have the return on the market as our dependent variable, and the return on our stock, we're calling our stock I here, as our independent variable. And then we're just going to plot observations over time. You know, how the two vary over time. We then use a process called least squares regression to calculate the line of best fit. Now, in fact, your calculator will do that. Do you remember when we were looking at the Lin mode on our BA2 Plus in order to calculate covariance? When we were scrolling through the data, we saw our calculator have A, which is our intercept point, and B, which is our slope. Okay, so when you do least squares regression, what it does is it minimizes the distance of the observations to what they call the line of best fit. Okay, now this line of best fit here has an intercept, they're calling that alpha there, and it has a gradient which is equal to beta. Okay, now notice no observation lies perfectly on the line, and the difference between an observation and a forecast value that lies on the line of best fit is the error term. This is our error term. We don't need to get too heavily into error terms right now. This is the return. The intercept is the return on the stock when the return on the market is 0. So it's the return on the stock independent of the return on the market. The return on the stock that you'd expect even if the market gave you a return of 0. Beta times Rm, well, beta is our slope coefficient, our gradient of our regression line. Rm is the return on the market. Now, the key point is now, once you've got your regression line, given an expectation of market returns, oops, oh, come back. There it is, sorry. Oops. Try and change my ink color. Once I've got an expectation of the return on the market, I can use this to forecast the return on my stock, the expected return on my stock. So we can now use our forecast of the market to generate forecasts of a return on a stock. Now notice the gradient of this is beta. Okay, the sensitivity of your stock returns to the return on the market. In other words, if you had a beta here of 0.5, what it would be saying is for every 1% the return on the market increases, the return on my stock will increase by 0.5%. If you've got a beta of 1, for every 1% the return on the market increases, you'd expect a 1% increase on your stock. And if you've got a beta that's greater than 1, let's say 1.5, for every 1% increase in the market return, we'd expect a 1.5% increase on our stock. Now, the error is going to be there for the return not explained by the market. And often, therefore, the error is a function of the unsystematic risk. So the error term is often unsystematic risk. Good. What if the market doesn't explain all non-diversifiable risks? So in our capital asset pricing model, the market is the variable used to explain all non-diversifiable risk. But what happens if the return on your stock relative to the market doesn't explain on all non-diversifiable risk? And in fact, as soon as CAPM was launched in 1964, or published in 1964, people started to take kind of pot shots at it, saying, well, look, it's not a complete picture of diversifiable risk. So people have been working with multi-factor models. Now, all a multi-factor model does is it increases the number of betas and the number of risk factors. Okay, so notice we've got the excess return on our portfolio here. Return on asset I minus the risk-free rate is equal to beta 1 times our risk factor 1, beta 2 times risk factor 2, etc. Now, betas are known as factor sensitivities in this particular case. The factors themselves, the F1, the F2, the FK, etc., are whatever you believe explains non-diversifiable risk. Okay. Now, this multi-factor model approach was developed, first of all, in 1976. So our multi-factor models really come in 1976 by Stephen Ross. And Stephen Ross is all over our syllabus, in particular our level 2 syllabus. So expect to see that name multiple times in portfolio management as you go through your CFA syllabus, not just in CFA, in the CFA portfolio management sections. He's going to come up in fixed income, he's going to come up in derivatives, etc. Okay, so very important name in the CFA world. He actually only just recently passed away, about 2-3 years ago, I think now. Okay, so he developed what's called arbitrage pricing theory, and all that really says is, hey, maybe there are multiple factors that we need to consider. We'll look more at arbitrage pricing later on. So your betas, we don't really call them betas when we're in a multi-factor model. We tend to refer to them as factor loadings, and these things are our factor premiums. Okay, now in CAPM, your factor premium is the return on the market minus the risk-free rate. We're going to see in a second. Now, many different types of multi-factor models. Macroeconomic factors, these use macroeconomic variables, or in fact, typically they use shocks to macroeconomic variables. So actual GDP growth, for example, compared to expected. Okay, and that would be our factor. And then beta would be the sensitivity of your stock's returns to this macroeconomic shock. So it could be actual GDP compared to expected GDP, actual inflation compared to expected inflation, consumer confidence, actual compared to expected, exchange rate, actual to expected. Again, it's all about shocks, all about when actuals differ from expected. And you get your macro factor models. Okay, so they're looking at shocks to macroeconomic variables. Typically, these models have relatively few variables to them because as you add macroeconomic factors, you start to run into a problem of multiclinearity quite quickly. So, for example, if you have interest rates in there and exchange rates, as interest rates vary, that causes exchange rates to vary. So you start running into problems quite quickly. So they tend to limit the number of macro factor models. The most commonly used multi-factor models are fundamental factor models. Now, fundamentals, what we're going to look at is all of our factors are going to be fundamentals of the company. It could be earnings, earnings growth, firm size, PE ratio, risk, etc. Funder payout ratios, anything that you think that is fundamental to the company that drives returns. Now, the third type of multi-factor models we have are statistical factor models. These are things like, for example, principal component analysis, PCA. Those of you who've done a bit of quants at university might be aware of principal component analysis. And essentially from principal component analysis, machine learning, which we have a lot on in the level 2 syllabus. Now, machine learning, what you're going to do is use computer programs to comb historic data, okay, and look for relationships of variables, or look for combinations of variables that seem to explain changes in return. Problem with that is the combinations they come up with and the values that they come up with often lack economic meaning. So they don't have much basis in finance theory, so they're hard to use to predict the future. Okay, now we're going to say no basis in finance theory, and therefore the syllabus is rather quiet about these statistical factor models. Okay, don't get too excited about those models. Clicking back again, have an awareness of them for your level 1, but we're going to do them in depth, talk about exactly what they mean, with the exception of 3, which we're still going to argue defies economic explanation even at level 2. Okay, so more on that at level 2. Now, probably one of the most famous models of all is Farmer and French's 3-factor model. Now, it had a risk-free rate, and then it had 3 risk factors. Now, the first one, or actually, let's take the third one. Third one is what CAPM already showed, the return on the market minus the risk-free rate. Okay, so the market risk premium. But more returns could be explained by firm size. Now, what Farmer and French argued, and this model was actually originally 1975, but actually it got published in full in 1995. One of the key factors that they said was firm size in terms of market capitalization. Okay, and their argument was that small firms outperform large firms on a risk-adjusted basis. So they looked at, to get their risk premium, remember their factors. Here, what they did is they looked at the natural log of companies that were essentially small cap. So it's market cap. And these were small cap companies. The natural log of returns of companies that were large cap. Okay. Again, they're using the natural log of market cap. Don't get too bogged down in why they use natural logs, but it's just simply because their market cap typically doesn't show a linear relationship over time. So they used a natural log. So basically what they did is they constructed portfolios here. They went long companies with small market capitalizations, shorted companies with large market capitalizations, and this is the excess return that they generated on this strategy. What part in our model is it? One of these Fs. So they might have this one as RM minus RF. This one might be therefore the difference in the natural log of market caps or returns. The next one they did is they then said, of all of the various relative valuation multiples that we encounter, the key one is book to market. Now, book to market is just the book value of equity over market value of equity. This is simply the inverse of the price to book ratio. Okay, so they've got price on the denominator and book value. Book value, of course, just means balance sheet value. Okay, so book value of equity, and of course, because of the balance sheet equation, assets equal liabilities plus equity, it's the same as saying the book value of net assets. So you're looking at the book value of net assets compared to the market value of net assets, or the book value of equity compared to the market value of equity. Now, we typically argue that companies with low price to book ratios could be undervalued. Exactly what they did, but because they're looking at price on the denominator rather than the numerator, they argued that companies with high book to market ratios were potentially undervalued. That's the same as saying low price to book. Okay, so what again they did here is they went long companies with high book to price ratios and shorted companies with low book to price ratios, and this was the return that they made on that. Carhartt, other than designing t-shirts, added a 4th factor, and his was momentum. What he did is he looked at I think it was about 40, it was using the S&P 500. He looked at the 40 stocks that had advanced most in the last 12 months, minus the 40 stocks that had declined the most in the last 12 months. So he added a 4th factor. Pastor Stamberg, which you encounter, I think, in equity, Pastor Stamberg added a factor, and that was liquidity. The idea that you need a higher return on a stock with lower liquidity. Okay. So the idea is, by introducing these additional factors, okay, these model equity returns better than our single index capital asset pricing model. Okay, so don't worry too much about multivariate models. Going to see it really at level 2. Just be aware how you calculate your betas here, and I know we're getting close to time. Notice they're using RI minus RF here, and previously when I did it on this slide way back here, there it was, I just said RI, RF, RM. Doesn't really matter essentially what you do, whether you subtract risk-free rate from both sides or not. Okay, here they've chosen to do that, so they've done your assets return minus the risk-free rate, the market return minus the risk-free rate, and then just plotted observations over time. They then fit that regression line, the line of best fit that statistically minimizes the error terms. It minimizes what we call the sum of the squared errors. More on that at level 2 to get our characteristic line. We have our intercept, which of course is the excess return on our stock, independent of the return of the market. We have our beta. Okay. What I tend to find is candidates get highly confused between capital asset pricing model and the securities market line and the asset characteristic line. The asset characteristics line is a regression. The security market line is not regression, it's just a graphic representation of CAPM. So, fair enough. So notice here is the standardized measure. Remember, I said actually, when you're looking at market risk, you can pick it up by looking at covariance of your stock against the market and then dividing by variance of the market to get beta, which is simply a standardized measure of systematic risk. Notice if you're calculating beta for a portfolio, let's imagine we've got a 2-asset portfolio, 60% in asset 1, and that has a beta of, let's say, 1.5, and 40% therefore in asset 2 to keep things easy, and it has a beta of, I don't know, 0.7, then the beta of the portfolio is 0.6 times 1.5. I guess I better do it now, I've said it. 0.6 times 1.5, 4 times 0.7, and I get an overall portfolio beta of about 0.93 in that case. Is that right? Seems a bit odd. Let's just check it. 0.6 times 1.5. 4 times 0.7. No, it's not right. I think it was. It looked too small. It's actually 1.18. There we go. Lovely. Yes, they're trying to link now between beta and correlation. Let's just take this formula here. Covariance against the stock of the investment against the market. Now we can write down our numerator as the correlation of the stock against the market times the standard deviation of the stock times the standard deviation of the market, divided through, our denominator is the variance of the market, divided by the variance of the market. Okay, now once we've split it out like that, which is what they're really doing in the second line on the slide here, is what you'll notice is you've got standard deviation of the market on both the numerator and variance of the market on the denominator. So that will cancel with the square there. So notice now what we're saying beta is. Beta is equal to the correlation of the stock against the market times the standard deviation of the stock over the standard deviation of the market. Okay. And that's exactly what we've got here. So another way of calculating beta is the correlation of the stock against the market times the standard deviation of the stock over the standard deviation of the market. And of course, by definition, the market portfolio itself must have a beta of 1 because it would be the correlation of the market portfolio with the market portfolio. That would be 1, and it would be over multiplied by the standard deviation of the market over time, divided by the standard deviation of the market. So this equals 1. So beta of the market portfolio always 1. Right, assumptions of our capital market theory. Investors use mean variance framework. In other words, they only operate on the efficient frontier. They are Markowitz mean variance efficient. What does mean variance mean? They aim to maximize mean return for a given level of risk. Okay, and that's of course what the frontier, efficient frontier, represents. The portfolios that maximize return at a given level of risk. Unlimited borrowing and lending at the risk-free rate. Okay, we saw we can not only combine the risky, the market portfolio with risk-free lending, but we can also leverage up. Okay, so leveraged portfolios are possible. In other words, you can borrow at the risk-free rate and invest more than 100% of your wealth in the market portfolio. Homogeneous expectations of what? Assets, expected returns, assets, expected risks, assets, expected correlations or covariances. Okay, homogeneous. Implication, there is only one minimum variance frontier, and therefore there is only one efficient frontier. And then when we add a risk-free asset to it, it means there is only one tangency portfolio that we call the market portfolio. Everybody has exactly the same tangency portfolio and risk-free asset. One period time horizon, this is just simply saying assets are correctly valued in one period. Okay, so any mispricings will be arbitraged. Divisible assets, not very exciting. This just means it is possible to hold the market portfolio. Okay, market portfolio contains all risky assets, as I mentioned before, and they're weighted according to market capitalization. So there is the possibility that you need to hold fractions of certain stocks to hold the market portfolio. And we're saying, hey, look, in our theoretical framework, we'll say this is possible. So divisible assets, frictionless assets, no taxes, no transaction costs. This means arbitraging mispriced securities is free. Okay, so as soon as a security is mispriced, it will be worthwhile taking out an arbitrage on it, and of course that will cause the securities price to correct. Okay, which is why we argue that these in the capital markets line and CAPM, the capital markets are in equilibrium. Okay. Now, inflation and unchanging interest rates just means a constant risk-free rate over our one period time horizon. Good. Right, okay, so we now get to our SML equation. Okay, so this is what happens when we, remember we originally had total risk and expected return. Okay, we had our risk-free asset, we had our efficient frontier, let's put a tangency asset on that. And we drew our line. This is a terrible drawing, like so. Oh, that's my capital allocation line. I'm not pleased with that drawing at all. Okay, CML. But the problem was it had total risk. So therefore, what we need to do is change it to systematic risk. And of course, our measure of systematic risk is our friend beta. Okay, so notice here is the SML equation. This is the equation for the securities market line. The securities market line is the graphical representation of CAPM, remember. So when we look at the securities market line, again, we're going to have expected return on our asset on this axis, but we're going to have beta on this axis. Again, we're going to have the risk-free rate. Again, that tangency portfolio should have been one. Do you know what? I'm going to just redraw this briefly because that's just such a horrible attempt at drawing the capital markets line. I embarrassed myself there. Okay, let's put it up here. Let's do our efficient frontier like this. Okay, so we end up with our, that's better, our tangency portfolio, which is the market portfolio, like so. As we said earlier, our measure of risk is incorrect, so we're now going to change it to beta. So now, again, this is the market portfolio from the CML. So now I can either invest 100% of my wealth in the risk-free asset, 100% of my wealth in the market portfolio, or some combination between. So again, as I move along here, this represents risk-free lending and investing in the market portfolio. If I go beyond the market portfolio, I'm looking at levered portfolios, risk-free borrowing and investing more than 100% of your wealth. And that is the securities market line. Now, one question the examiners always like to test is, what is the gradient of the securities market line? And one of the answers that sits out there will be beta. And beta is not the gradient of the securities market line. Can't be. Look, beta is on the x-axis. So how can it be the gradient? The market risk premium, this element here, RM minus RF, that is the gradient of the securities market line. The intercept, of course, is still the risk-free rate. So therefore, CAPM gives you the expected return on an asset based only on the asset's systematic risk as captured by our standardized measure of systematic risk, which of course is beta. And again, on the previous slide, there you go. This, remember, is the unstandardized measure of systematic risk. Take the covariance of the stock against the market, divide by the variance of the market, and you've got your beta. Okay, so CAPM is the expected return on an asset based only on the asset's systematic risk, or beta. So, of course, what that means is if we know an asset's beta, we can tell you what required return it should have given that level of systematic risk. Required return and expected return are the same in equilibrium. So if assets are priced correctly according to CAPM, then their required return, which is given by CAPM, i.e. risk-free rate plus beta times RM minus RF, that's the required return from CAPM, will be equal to the expected return. And we calculate the expected return by looking at holding period return. In other words, value of the investment at the end of the period plus any cash flow received over the value of the investment at the start of the period, minus 1, typically. So holding period return and required return, or expected holding period return and required return, will be the same if the market is in equilibrium and securities are fairly priced. Okay, so here is our securities market line. There is our risk-free rates. There is the market portfolio. And there is our securities market line. Okay, note therefore the market portfolio, as we said before, has a beta of 1. It must do. How does it vary with itself? Perfectly, okay, has a perfect positive correlation. And of course, the market portfolio has an expected return equal to the market. But the idea is now, given a stock's beta, if I know our stock has got a beta, let's say up here, higher beta than the marketplace, I can now plot up to my securities market line and work out my expected return on a particular security. Right, okay, let's do that then. Let's do it together first of all, because I think this is nice and straightforward. A stock has a beta of 1.2, expected return on the market is 8, and the risk-free is 2%. What's the expected stock's return? Well, market risk premium is 6%, 8 minus 2. So we're going to do 8 minus 2 to get the market's excess return for risk of 6, multiply by 1.2, and then add the risk-free rate. So there's the risk-free rate, 2%, plus beta times RM minus RF, the market risk premium, sometimes referred to as the equity risk premium. Okay, and as we said before, that is our required, I don't like the fact it said expected return. Well, look, if you believe the market is in equilibrium, then expected and required return are the same. Typically, I think of using CAPM to get my required return. Okay. The return I require on a stock, given its level of systematic risk. Okay, so in this case, we get a value of 9.2%. Now, if the stock is actually going to generate a higher return than that, we think, then we've got an undervalued stock. And if the stock is going to generate a lower return than 9.2%, we've got essentially an overvalued stock. And that's where we're going next. Okay, so an analyst has forecast the following for 3 stocks. We've got a risk-free rate of 7% and an equity market return of 15. Nice, this must have been written some time ago. So RM minus RF is equal to 15 minus 7. So we've got an 8% risk premium. Now notice what we've been given here for stock A, B, and C. We've been given the price today, the forecast price in 1 year, and the forecast dividend in 1 year. And of course, from that, we can work out holding period return. Okay, so I'm going to just do it for each of our stocks on this slide. So for stock A, holding period return, and this is our expected return. If I do it as 27 plus 1 over 25, the 28 divided by 25 minus 1, and I get 12%. So therefore, holding period return on stock A, the expected return on stock A is 12%. Let's do the same for stock B. 40, oops, sorry, that's the price today. 45 plus 2 over 40, and then I'm going to subtract 1. So 47 divided by 40 minus 1. So this has a 17, I'll scribble it over here, 17.5% expected return. This one was 12%, as we saw. And then the final stock, 17 plus 50 cents over $15 minus 1. So 17.5 divided by 15 minus 1, and I get 16.7%, let's say. Okay, so we've got the expected holding period return. Now what we can then do is use our betas and the risk-free rate and the equity risk premium to work out the required return on each stock. Okay, now there's our forecast return on stock A. There's the 12%. Notice our required return using CAPM, 7% risk-free rate, equity risk premium 8%. Okay, and we've told that this stock has a beta of 1. So 7 plus 8 gives us 15%. So we're going to calculate Jensen's alpha, and Jensen's alpha is calculated as expected return minus required return. Okay, so 12 minus 15 gives us a negative alpha, and that tells us that this stock is an overvalued security. We need 15% to satisfy our required return, given its level of systematic risk, but it only generates 12%. Stock B, there's its holding period return, expected return of 17.5. Cap M says we only require a return of 13.4. So 17.5 minus 13.4 gives us an alpha of 4.1. A positive alpha here represents a undervalued stock. We require, given this stock's level of systematic risk, a return of 13.4%, but it's generating, or expected to generate, 17.5, more than we need to cover our level of systematic risk. So an undervalued security. And stock C, okay, so the expected holding period return, 16.7 or 16.6, and cap M, 16.6. So this is a correctly valued security. It's neither over or undervalued. Again, we can have a quick look by plotting these. There's our risk-free rate, there's our market portfolio, and there's the securities market line. If you were to plot these, again, notice we've got expected return on our y-axis. Again, that's the holding period return. Stock A plots below because, of course, we said that it is overvalued. Stock B plots above because it is undervalued. And stock C plots on the securities market line because it is correctly valued. Okay, the securities market line, of course, represents the cap M required return. So stock A, overvalued, so short sell it. Stock B, undervalued, okay, and therefore buy it. And as you do that, of course, as you start selling stock A, then its price goes down and its returns as a function of price will go up until, guess what? It ends up back on the securities market line. Stock B is undervalued, so people start to buy it. Its price goes up, so return as a function of price starts to come down until, again, the market is efficient. It ends up back on the securities market line. Okay, so stocks will plot on the securities market line if they are efficiently priced. Right, let's have a go together, I think we'll do, because I know we're running late on this, as I always tend to do. Okay, so let's just quickly finish off this question, and I want to just quickly end up with a little bit of abnormal return stuff. So expected return on the market 15, risk-free rate 8, stocks beta 1.25. So let's use this to work out our required return given CAPM, given the stock's level of systematic risk. So 8% plus stocks beta 1.25 times the return on the market minus the risk-free rate. So let's have a look at that. What do we get there? 7 times 1.25 plus 8, 16.75%. Okay, that's my required return. Required given the stock's level of systematic risk. Forecast return, we're actually told here, we don't have to calculate it, 17%. Oh, good. It's giving me too much return, and therefore it must be an undervalued stock. Okay. How much we could compute how much it's undervalued by looking at Jensen's alpha, which says 17 minus 16.75%, which is 0.25%. So the answer is C. Nice and straightforward. CML versus the SML. Well, all this is saying is that if we look at this CML, and remember we're looking at total risk when we look at the CML, only securities D, M, and E are generating, or the market portfolio is always on the CML. So it's really only portfolios D and E that lie on the securities market, on the capital markets line. So that those are the only securities that are generating the correct return given their level of total risk. Okay. Yes, D lies somewhere between the risk-free rate and the market portfolio. So therefore, it represents a combination of the market portfolio and risk-free lending. Portfolio E above the market portfolio, so that must be a combination of the market portfolio and risk-free borrowing. Securities A, C, and B, of course, are inefficient portfolios based on total risk, of course. Okay, lovely. And yes, security B has the same beta as the market. It does. Interesting. Okay. Right. Now, when we look at the securities market line, notice any security that is efficiently priced, meaning essentially any mispricing has been arbitraged away, will lie on the securities market line. So based on systematic risk only, it appears all of our securities are correctly priced. Therefore, those mispricings on the previous slide for A, C, and B must have come from unsystematic risk. When we eliminate unsystematic risk and only look at systematic risk, it actually appears that all of the securities are correctly priced. So SML is based on systematic risk, not total risk. Any asset that plots on the SML is in equilibrium. Okay, its required return is equal to its expected return. And that includes even inefficient portfolios, because we saw those inefficient portfolios on the previous slide wasn't caused by systematic risk, it was caused by unsystematic risk. Good. Yes, and it means a low beta stock. A stock that has a low beta, like portfolio C, you can see its beta is way below the market here. Okay, there's the market's beta, there's stock C's beta. Okay, it looks low risk when you look at systematic risk, but when we looked at the previous slide, when we're looking at total risk, it was way out here. What is that telling you about stock C? Well, it's telling you that you've got a lot of unsystematic risk there. Good. Right, last couple of slides. CML applications. So this is all about spotting abnormal returns or measuring abnormal returns. Okay. So let's put on our efficient frontier and our capital markets line, CML. Okay. So note, standard deviation or total risk is our measure here. And there's our CML slope. We know it has a slope equal to the Sharpe ratio, return on the market minus the risk-free rate divided by standard deviation of market. Now, we've got a portfolio there, P1. Now, P1 lies on the capital markets line, okay? So if you work out the return on portfolio 1 minus the risk-free rate over the standard deviation of portfolio 1, it's going to give you the same slope as the CML, okay? If you plot on the CML, you've got the same slope. Now, what about P2? Now, notice our portfolio 2 there, P2, it is on a higher capital allocation line. What does that tell us? It's got a slope that is greater than the CML. Okay. And of course, what that means is it's generating more excess return per unit of risk than the CML. So I'm always going to choose portfolio 2 given a choice between portfolio 1 and portfolio 2. So notice that comparing the gradients, the slope of portfolio 2's capital allocation line is greater than the market. So this is a security that is expected to beat the market on a risk-adjusted basis. Of course, if you had a slope that was lower than the capital markets line, then you've got an overvalued security that's expected to underperform the market on a risk-adjusted basis. M squared. Now, don't look for any mathematical reason for M squared. This actually comes from who developed it. It was developed by Franco Modigliani and his goddaughter. Now, what was his goddaughter? Sorry, granddaughter, I think, called, is it something like Zara? I can't remember what her name is. Anyway, you've got two Modiglianis, and that's why it's called M squared. It has got nothing to do with mathematics, okay, or squaring anything. Just simply two Modiglianis. Now, what they're saying here is, look, we want to calculate a risk-adjusted return measure. But I can't simply compare the return on portfolio 2 to the return on the market because portfolio 2 has too little risk. So what I'm going to do is I'm going to leverage portfolio 2 up so that it has the same risk as the market. So I'm going to borrow at the risk-free rate and invest more than 100% of my wealth in portfolio 2 until its risk increases such that it now has the same return as the market portfolio. Now, the significance is I now can compare that with that, okay? And the difference is the M squared measure. Okay. Do you need all the formulas on this slide? No, I think I was just going a bit overkill when I wrote them out there. Okay, but notice what we're doing is all you're doing is taking the excess return on portfolio 2 and then essentially increasing it so it has the same risk as the market, and that therefore gives you the return on portfolio 2 after you've adjusted its risk to be equivalent to the market minus the risk-free rate, and that of course is just the market risk premium. You're comparing the two, and the difference is your M squared measure. Final slides, calculating risk-adjusted returns using systematic risk. So what we've just talked about here, the M squared and the Sharpe, good measures of abnormal returns, but really only for undiversified investors. Because if you're well diversified, then we've got the wrong risk measure. If you're a well diversified investor, then maybe we should look at whether your securities are generating abnormal returns by looking at beta. Okay, there's our market portfolio. There's our securities market line. Fabulous. Now we've got a security here that pops above the securities market line. So one measure we can do is calculate the trainer measure. Now we know the gradient of the securities market line is the return on the market minus the risk-free rate divided by 1. Okay, because that is the beta of the market, isn't it? So because it's the beta of the market, we tend to write the gradient of the securities market line is just equal to the return on the market minus the risk-free rate. Okay. Typical, just where I put the ink. I will give you a couple of seconds if you're busy writing that down. and a gain. Now, trainer, notice it looks very, very similar to the Sharpe ratio, only its measure is beta. So the return on portfolio 1 minus the risk-free rate over beta 1. And we'll compare that to the slope of the SML, which is RM minus RF. As I said, if you don't like that because you're thinking that's a bit weird, it's over a beta, isn't it, of the market, which is equal to 1. Okay. So we're going to compare the slope of the portfolio compared to the slope of the market portfolio. And if it's greater, then we again have got an abnormal return. Jensen's alpha, the other way of doing this is essentially to look at your expected return compared to the CAPM required return. This is just what we were doing on the previous slides, wasn't it? Where we were looking at holding period return or expected holding period return relative to CAPM. Okay. So again, if it's positive, remember you're undervalued. If you get a negative value, it's overvalued. If you get a value of 0, then it is correctly valued. Fabulous. Additional problems if we have time? No, we don't. But what I would say with this is feel free to work these questions in your own time. And at the end, everything that we've done in class that had solutions is included here, including those questions that we haven't got time to look at. So if I keep on scrolling through, there you go. So here are the questions at the end. So you have got the solutions if you want to look at those questions. Perfect. I promised that I would look at your queries as they came in, and I, of course, haven't done that yet. So I'm going to stop sharing my screen, and I think that will, I'm hoping. You are sharing a screen, I know. How do I stop it? Okay. Right, okay, I think I can now, I've got myself back to this. I can look at your chat and see if I can help you. Will you have access to the recording of the meeting? Yes, says Helene from the CFA Netherlands Society. And in fact, not only have you got access to this after this meeting, but we did a fixed income one just prior to Christmas as well. So you can have a look at that one as well. Can you read the indifference curve as difference risk return trade-offs? This is Patrick, given a constant level of utility. Absolutely, Patrick. Not only can you, but you should interpret as that. So the indifference curve slope is the trade-off between risk and return, given a constant level of utility, happiness. How many assets can a portfolio have before the benefits of diversification start declining? Well, the answer is theoretically, you would need to hold the market portfolio, and that contains all risky assets to totally eliminate unsystematic risk. But in practice, once you've chosen a portfolio that contains 30 per the CFA Institute, okay, and if it's what the CFA Institute says, it's what we say, otherwise we don't get the question right. So I would say, therefore, 30 well-chosen stocks, and you've captured most of the benefits of diversification. Thank you. That was from Gregory. No one holds inefficient assets. Wouldn't the price decline to a point in which the cheaper price would make it efficient to hold? Great question, Natia, I think your name is. I'm sorry if I pronounced it wrongly. Or maybe that was Gregory's question. Can't tell. Anyway, brilliant question. Yes. And that's why the market portfolio contains all risky assets. Because remember what we do when we construct CAPM, that list of assumptions that we make, we assume that markets are fairly valued. So all securities are correctly valued. And you're right. If a security was not correctly valued, there'll be no demand for it. Let's say it's overvalued. There'd be no demand for it. So its price would fall until it is worth holding in the market portfolio again. So absolutely, if no one holds an inefficient asset, its price declines until it's no longer inefficient and it's back in that market portfolio. Absolutely. Beautiful. Standard deviation also measures upside volatility. Yes, it does. It's deviation around a mean. Okay, and of course, In quants, I think, do they have partial variance where they only look at downside risk, or has that been taken out of syllabus? Long time since I looked at level 1 quant. There are measures essentially that only look at downside risk. But really, typically when we talk about volatility, it is up and downside. It's total dispersion around the mean. Okay, so when we say risk, people think, oh, it's bad. Risk's a bad thing. But actually risk, you know, is upside and downside potential. So it's a really good point that you make there, Gregory. Yeah, like that. Let's have a look. Also, you mentioned, is that the same as alpha? I don't remember what we were looking at when you wrote that. However, alpha would be the difference between, well, it's the trainer measure, isn't it? It's the difference between what the stock is expected to generate and required return. That is our alpha, essentially. So expected return compared to CAPM return, the difference, that is alpha. Or at least it's a measure of alpha anyway. Certainly in level 1, until we get into multi-factor models, it will do us. When to use the market model and when to use CAPM? Well, CML should be used for undiversified investors. Okay, so if you were looking at an investor, they were not well diversified, you were looking at maybe investing in a company that wasn't exchange traded, then maybe market model is better because you're looking at systematic and unsystematic. You know, family-owned companies as well. The family will be unlikely to be well diversified, so they're exposed to systematic and unsystematic. So use market model. However, if we're looking at investors that are holding exchange traded securities, then it makes sense for the investor to diversify because, of course, you're eliminating the unsystematic risk without affecting your return. Downside risk and Sortino ratio. Yes, we can measure downside risk by only looking at deviations below the expected return. And Sortino ratio, is that measured in level 1? I think it is measured, mentioned at level 2. So we will we'll come back to those points at level 2. Thank you so much for taking the time out. I'll give you an extra half hour of my time. So I missed the start, but gave you an extra half hour at the end. Thank you so much for listening. I hope this has been a useful presentation, or at least a useful lecturette. Remember, we covered an awful lot of ground in 2 hours or 2.5 hours. We did most of portfolio management, all apart from the kind of easy, chatty stuff, essentially. So remember, the archives are there for you to drop back in on. Remember as well, if you like this, there's one around on the archives for fixed income that I did. And again, fixed income is, per the CFA Institute, it's the area that people find the most tricky. So lovely. Thank you very much for listening. I don't know if Helene wants to say anything before we sign off.
Yes, Jonathan, I want to thank you so much for again treating a difficult topic and explaining it in a manner that even I might understand. So I've expanded my vocabulary, and I'm sure it was very useful for all of the participants. I would just like to mention, you already mentioned to look at the website for the fixed income exam prep workshop, and there's also an opportunity to form let me put my video on, to form study groups if you like. If maybe for February it's a bit late, but if you would like to join a study group for the May exams, you're welcome to let me know, and I'll put all of you together. In 2 days, about 2 days, the video will be on the website, so you know. Okay, thank you very much everybody for joining us, and especially Jonathan for being with us this evening, and I wish you a lovely evening from now on.
No problems. Thank you very much, everybody, for joining it. Thank you.